Good evening, everyone. The number is just five. And let's start with this five. Okay, let's start with this five, right? Good evening, everyone. Um, Today we'll be looking at chapter two, which is the regulatory environment, right? In this chapter, we'll be starting with the need to regulate the audit and assurance services. Now, this chapter two entails some of the reasons why the audit and assurance service profession is still relevant till today, knowing fully well that regulation has played a major role in helping to put checks in place for the continuing relevance of the audit and assurance services or profession, so to say. So we're going to look at the need to regulate. Why do we need to regulate the audit and assurance service? One of the reasons why we need to do that is because of the public interest. Because the public perceived the assurance providers to be impartial and having a professional view on issues that matter to users of the financial information. Okay, they believe that they can be trusted. What this implies is that the public, which could also be said to be the investors, okay, they rely solely on the auditor's report. In fact, before they make any investment decision, they always await the publication of the auditor's report, because it's that report they believe will give them the green light or the go ahead to rather invest in that organization or to continue to invest in that organization or not. So that is why they have so much confidence on the audit report. Number two reason why we need to regulate audit and assurance services is because of ethical regulation. For you to become an assurance provider, you have to imbibe the various ethical principles of the Institute of Chartered Accountants of Nigeria, okay, as well as other regulations of other professional bodies. So, for you to be a chartered accountant, there are certain principles you need to imbibe, and those principles are discussed in detail in chapter 3. We call it the fundamental principles. Some of them include you have to be independent, you have to be objective, you have to have integrity, you're able to keep information that's confidentiality. You must always act in line with established laws and regulations, that's professional behavior, and you must always be updated with information from time to time. That is professional competence and due care. All of these constitute the ethical regulation. Every country has its own ethical regulation. For us in Nigeria, knowing fully well that the audit and assurance service is being regulated by the Institute of Chartered Accountants of Nigeria, which was established under the Act number 15 of 1965, gives us the enablement, okay, gives the ICANN the enablement to function in that capacity to be the regulator of the audit and assurance services in Nigeria. Okay. Then we have the third reason why we need to regulate audit and assurance services, and that third reason is what we call the ethical regulation. All right. Now, under the ethical regulation, what we mean is that the Institute of the profession, audit and assurance services, are still being of relevancy today, all right, because of the involvement or the role that the CAMA and every other regulation play in the relevance or continuing relevance of the the audit and assurance services. Okay. Then we have the last one, which is the professional regulation. That looks at the role the auditing standard plays in the continuing relevance and regulation of the audit and assurance service, because there's no audit anyway that you're going to embark upon that will not rely or you will not need to conform with the relevant auditing standards that pertains to that particular engagement. We're also looking at this chapter also looks at the the audit professional standard. How do the auditing standard came into being? We need to look at the professional standard. Now, for the audit and assurance services, the body responsible for the publication and issuance of auditing standard is the International Audit and Assurance Standard Board, okay, which is part of the International Federation of Accountants, IFAC. So they issue the international standard on auditing, international standard on assurance engagement, international standard on review engagement, international standard on quality control, international standard on related services. All of these are issued by the IAASB. And also in Nigeria, we have our own local standard, which is issued by the Financial Reporting Council of Nigeria. Okay, our own local standard is known as the Nigerian Standard on Auditing, NSA. So the ICANN plays a pivotal role in the publication of this Nigerian Standard on Auditing. They work hand in hand with the Financial Reporting Council of Nigeria. Now, there are times when there will be conflict between the local auditing standard and the international standard on auditing. What is expected is that when there is conflict, local standard will do what? Will prevail. Local standard will prevail over the international standard on auditing. The only instance where the international standard on auditing will prevail is if there is no ready or corresponding local standard. That is when we make reference solely to the international standard on auditing or any standard, auditing standard issued by the IAASB. Are we together? Are we together, please?
We are listening, sir.
Okay, so that is the much that you need to know about the auditing standard, both the local one and the international one. All right. So that is what we need to know about the two of them. Now, let's look at another area, which is the corporate governance. Now, corporate governance is another aspect that also try to explain the role that regulation play in the responsibility of the following people when it comes to corporate governance. Now, what is corporate governance? Corporate governance is a system of rules and practices and processes by which a company is directed and controlled. So the way and manner in which a company is being controlled and directed is known as the corporate governance. Now, corporate governance was introduced in order to instill confidence on the investors, okay, in the publicly listed entities. After the Enron Corporation, the failure of the Enron Corporation in the early 2000s, there was a need to institutionalize confidence of the investors, and that was why the corporate governance was started. But prior to that time, in Nigeria, right, we have our own corporate governance as far back as 2003 and 2011 and the Nigerian Stock Exchange. All right. So, and before that, we also look at the role the corporate governance play. What are the importance of corporate governance? Number one importance of corporate governance is that it helps to streamline processes and gives people accountability. Because if with corporate governance in place, you're able to know whose responsibility it is or is it to perform certain roles and responsibilities. Like for instance, the role of the auditor cannot be the same as the role of the directors, as well as the audit committee. They have divergent roles. Number two, it helps to lower risk because you're able to nip the issues in the board before it becomes a greater problem. Okay, you're able to see it and resolve it at the onslaught before it becomes something that goes out of proportion. Number three, the public, they are yearning for corporate governance now. All public entities, the investors are agitating that there's need for them to embrace corporate governance because that is, it helps to show the transparency of operations and financial reporting of each organization. Then another reason for corporate governance is because of corporate image. any organization that has institutionalized corporate governance is seen as an organization that is ready to transform or ready to work in line with established rules and regulation. And every company that has institutionalized corporate governance attract investors because they know that their investment will not go down the drain. Okay. So looking at the corporate governance, there are roles that are played by both the directors and the auditors as well as the audit committee. So let's look at the responsibilities of the directors as well as the auditors as regards corporate governance. Okay. Number one, if you look at the role of the directors, they are responsible for the preparation of financial statements. They are the ones that are supposed to prepare financial statements. Number two, they are the ones responsible for setting up internal control, putting in place an effective internal control system. Number three, they are responsible for providing the auditor with access to information relevant to the preparation of the financial statement, to also provide additional information relevant to the audit. They are also responsible for giving unrestricted access to auditors, access to persons responsible for the preparation of financial statement. And lastly, they are responsible for providing written representation where necessary to the auditors. Why the auditor's main responsibility is to ensure the financial statements are prepared in line with the applicable financial regulatory framework. So I was saying that the Code of Corporate Governance has been in existence since 2003 as well as 2011. And I said it was first used in Nigerian Stock Exchange Commission in those two periods, 2003, 2011. But it became prominent in 2005 when the banks were consolidated and there is a need to draw up a framework of operation of how the banks will work. And that was what gave rise to the corporate governance for consolidation of banks in 2005 and 6 respectively. Okay. So what it does is that the corporate governance, like I said, we have looked at what the benefit to organizations, okay? Then we also need to look at the role it played in the Nigerian banks for 2006. So the establishment of the Code of Corporate Governance for banks helps to streamline processes. For instance, we're able to determine the tenure of the bank chief executive. During that establishment of the Code of Corporate Governance for banks, that made all the bank chief executives to resign because most of them, if not all, have stayed more than 10 years in that position as the bank chief executive. The likes of Tony Elumelu, Jimovia, Fola Adiola, okay, all of them, Shibumi Balu from Blessed Memory, all of them, they had to relinquish that position for other people to occupy. So that is the role of corporate governance in the banks. Now, if you look at the composition of the board or audit committee, now what you need to realize here is, and I've said it with that number, if you are making use of the ICANN audit material for 2019, that light and blue cover, that sky blue cover, I will employ us to jettison that material because the information contained therein is outdated. Okay, the information contained therein is outdated. So you as not to confuse yourself, I have advised that you desist from using that material going forward. Okay? You desist from using that material going forward. So what I will expect is that you make use of the 2021, the one that is available on the ICANN website. You make use of that material. That is better. Okay, that is the updated version. That is the current version that they use for the syllabus. Okay, please do download that one. All right. Then let's go on. Let's look at the audit committee, because if you look at that 2019 Commission Audit Committee in that light blue cover, you see 6 as composition, equal number of members and non-executive directors. But in this new composition, as a result of the revised CAMA 2020, the composition of the audit committee has dropped to 5, 3 members and 2 non-executive directors. That is 3 board of directors and 2 non-executive directors, making 5. And one of them must have an understanding of the financial reporting and analysis. Okay, so that is what you need to know. All right. So those people that are in the audit committee, who are they? The audit committee is a subset of the board of directors. Okay, they are empowered. Okay, by the board of directors. So rather than wait for the board to sit on certain matters, they can delegate the audit committee to be started with that responsibility. Okay, to be started with that responsibility. So it takes responsibility on behalf of the board. All right. They are not entitled to salary, right? But entitled to allowances, sitting allowances, and they are eligible for re-election annually. All right. So they are eligible for re-election annually. All right. So that is what we need to know about that. So let's look at the functions of the audit committee. The function of the audit committee is as stipulated in CAMA, and the functions are to ascertain whether the accounting and reporting policies of the company are in accordance with legal requirements and agreed ethical practices. That means they must ensure that the financial reporting is in line with the applicable financial reporting framework. Number 2, they are responsibility of reviewing the scope and planning of audit requirements. So when external auditors come for audit, it will be the first point of call to review the audit plan and requirements, okay, as put together by the engagement partner. They are responsible for reviewing the findings of management matters in conjunction with the external auditors and department responses thereon. So when internal auditors external auditors give queries or queries, yes, let me use the word queries to the heads of department, their responsibility is to assist the heads of department to review their responses to those queries as a result of the external audit. All right. They also keep under review the effectiveness of the company's system of accounting and internal control. They review and ensure the effectiveness of the company's internal control system and the accounting system. All right. They also make recommendations to the board as regards the appointment, removal, and remuneration of the external auditors of the company. Okay. So those are the functions of the audit committee. And let's look at the duties and responsibilities of the audit committee. Number 1, they are responsible to ensuring that all members of the audit committee should be financially literate and should be able to read and understand financial statements. I've said that before. All right. It also ensures that at least one member of the committee should be a financial expert and have current knowledge of accounting and financial management and be able to interpret financial statements. Okay. While for the private companies, members of the audit committee responsible should be the non-executive directors, and majority of them should be the independent non-executive directors. All right. So all these are some of the conditions that must be fulfilled in the Nigerian Code of Corporate Governance for 2018. Okay, what I just spelled out now. Do you have any question, comment, observation before we proceed to the next subsection? Any question? I had to do a repeat of this because last Saturday, some of our students said that they couldn't get the recording, and the recording was not full as at the last, as per the commencement of this chapter when we started. That's why I had to start all over from chapter 2 this night or tonight. So I'm able to give an opportunity to everybody that sign on today to have an holistic view or a complete session of that chapter 2 that we started last week. We didn't complete it last week because of time. But today, I'm trying to ensure that this chapter is completed within the allotted hours. That's what I'm asking. Do you have any question before we proceed? Any question, comment, observation? If there are no questions, we proceed to the next subtopic, which is money laundering. Now, what is money laundering? Money laundering is something that we are all familiar with now, coupled with the fact of the issue that happened some years back when this guy, Hush Puppy, Abbas Ibrahimola, was arrested, prosecuted, and extradited to the US, where he's serving currently his data. I don't know whether he has been released or his data is still running concurrently. All right, but he was the one that helps to expose more insight into the activities of the money launderer. So, what is money laundering? Money laundering is explained in the Money Laundering Prohibition Act of 2011, and it's defined as the act where any persons in or outside Nigeria, directly or indirectly, conceals or disguises the origin of, convert or transfer, remove from the jurisdiction, acquires, uses, retain, and take possession or control of any fund or property, knowingly or which he should reasonably have known that such fund or property is or forms part of the proceed of an unlawful act. Okay, part of the proceed of what? An unlawful act. So the act explains what you mean by unlawful act. An example of unlawful act is Yahoo Plus, which is known as causing bodily injury or death to another person. It's an unlawful act. To take the life, to unalive another person is an unlawful act. To engage in money laundering activities, okay, to engage in racketeering is another unlawful act. What is racketeering? When a group of people decide to just cause scarcity or to launch the instability in an area to achieve their common interest. That's racketeering. During psychotropic substances, the use of all those banned substances like cocaine, hard drugs, and the likes. Okay. Child trafficking. Okay. Which relates to baby making factory and the likes, or people that they send to go and do housemaid. All of these constitute money laundering or unlawful act. Fraud also is part of it. Currency counterfeiting is also part of it. Okay. So these are some examples of unlawful acts. Because why are they called unlawful acts? Sometimes you see people that engage in this kind of practices, you see them daily, you think that they are into legit business, not knowing that what they are doing is that they are disguising the source of their ill-gotten wealth. Okay, so that's why it is termed money laundering. All right. Then, what do you need to know about money laundering? For instance, anytime you are traveling out of the country, you are expected to disclose the foreign currency that you have with you. So, anytime you have money above $10,000 or its equivalent in other currency, you're expected to disclose it to the immigration officer or the custom officer. Failure to do so will lead to forfeiture of such funds, okay, and imprisonment of not less than 2 years, or so forfeiture of such funds and imprisonment combined together. Well, this was practiced particularly in some years back when the then governor of Jigawa State, Sule Lamido, his sons were traveling out of Kano International Airport, and they had over excess of $10,000 on them, and they failed to disclose it. But when they were accosted by the custom and immigration, they were stopped. They were stopped from traveling out of the country. They were prosecuted, and this also affected the political career of their father, Sule Lamido. So that is an example of what transpired at that time, to explaining what we mean by failure to disclose excess cash up to 10,000 naira with you when you are traveling out of the country. Then we also have what we know as casino. What do you mean by casino? Now, casino is a place where you gamble, okay, with cards, stakes, and other materials. All right. Though it's not popular in Nigeria, but there are some states that you find this thing. You are located. You have them in Abuja. You have them in Lagos. What this law explains is that if you have such places like a casino, you have to keep record of people that visit those places. At least that record must be kept for at least 5 years. All right, must be kept for at least 5 years before they are discarded. Okay. Now we also look at it from the angle of anytime you also want to deposit money. As an individual, the amount you can deposit in cash is 5 million naira. Anything above 5 million naira, the bank has the right to inform EFCC that you are depositing above 5 million naira. While for the corporate body, the minimum per day is 10 million naira. So if the company wants to deposit above 10 million naira per day, the bank has the responsibility or obligation to report such companies to the EFCC. Okay, I hope you get it. We also have what we call money laundering agents, conspirators, and accessories. Now, when an accountant or when an audit firm is serve as the auditor for a company that engages in money laundering activities, under such circumstances, the audit firm will be seen as what? Accessory or agent. And where they fail to report, when they have clients that are into this kind of activities, they become conspirators. Okay, that means they are conspiring together. Okay, they are working against the state. That's what it means. That would be a conspiration or conspiracy. All right. Now, what we are saying now is that for the accounting profession, it is expedient that all audit firms, they need to do what? They need to inform, educate, and train their staff, all right, on the need to be able to detect, unravel, and report on money laundering with related activities. Okay, money laundering related activities. Now, for the accounting firm, where the firm is being prosecuted, the partners can be prosecuted separately, or the firm itself can be prosecuted alongside the partner. All right, depending on which one the court presided over. All right. So what I can say now is that every other member should be aware of Money Laundering Prohibition Act and should guide against being seen as an agent, conspirator, or an accessory to money laundering activities. You remember that in chapter 3, we're talking about confidentiality. That is, under circumstance should the accountant divulge their client's information. But when it comes to money laundering, this is an exception. Because of that, you can even divulge your client's information because of money laundering. Okay? It's better for you to give a false alarm for money laundering than for you to keep quiet and be seen as an accessory, a conspirator, or an agent to money laundering. Okay? So how will the audit firm guard itself against the money laundering activities? Number one, they must train their staff to be able to detect any activity that could warrant and be treated or seen as money laundering. Number two, the NHF should appoint a money laundering reporting officer. Who is the money laundering reporting officer? He is charged with the responsibility of collating a report for the audit firm and filing it or submitting it to relevant government agencies, okay, so that they can be aware or kept abreast of activities that can be described as money laundering. Number three, they must be able to train their staff so that they can report correctly on any instance of what money laundering. So that they can discuss extensively on any instance of what money laundering. Okay. So what it means is that once an audit firm incorporates this into its policies and procedures, then in a way, it has equipped its staff on the various methods or guidelines to use when there is any suspicion of money laundering related activities. Okay. Hope we are getting it. Do you have any question? Any question? Are we together? Please, someone should respond, please. I don't know if we can hear me.
We are together, sir. We can hear you.
Any question?
No question, sir. Only.
All right.
Yes.
All right. Thank you very much. I think it shows that I'm communicating. It's supposed to be a two-way communication, right? Now, let's take a look at what we have discussed so far before we come to the next area of discussion. So I said we started with what? With the need to regulate audit and assurance services. And there we look at main reasons why you need to regulate audit and assurance services. There are four of them. They're represented by public interest. Number two, we have ethical regulation. Number three, we have legal regulation. Number four, we have professional regulation. Now, what do we mean by professional regulation? What we mean is that every auditor or chartered accountant must be aware of all the audit standards that relates to each particular engagement or all engagement that is being recorded within the audit firm. All right. We move on to looking at corporate governance. Before we get to corporate governance, we look at the professional standards. And I said that for auditing, there are two standards that you need to know. You have the local standard, which is the Nigerian standard on auditing, and you have the international standard, which is the international standard on auditing. Now, what we meant is that the local standard, Nigerian standard on auditing, is being issued by the Financial Reporting Council of Nigeria under the auspices of the Institute of Chartered Accountants of Nigeria. Okay. Now, when you look at the professional standards, right? There are times when there are conflicts between the local standard and the international standards, auditing standard. Now, when conflicts arises, the local standard prevails. The only time the international standard prevails is when you don't have a corresponding local standard. All right? When you don't have a corresponding local standard. Okay? Then we want to look at the reason why we cannot harmonize the audit and assurance services with the accountancy profession. Now, the reason is that different countries have different regulations and legislation that don't necessarily promote the harmonization of both professions audit and assurance and accounting services, and accounting, audit and assurance and accounting profession. Okay, you cannot harmonize them together. As a result of different countries have different laws, which sometimes might be rigid, okay, or not easy to bend or to tweak to accommodate new developments. All right. Then we went on further to look at the corporate governance. And I said that corporate governance has been in existence in Nigeria since 2003. Okay. The Nigerian Securities and Exchange Commission, they have to put in place the first set of organization that establishes code of corporate governance. Okay. Then also we look at the banking sector, another aspect that we have seen the relevance of the corporate governance. I talk about 2005, 2006. Okay, so it helps in lowering risk. What we mean by that is that for issues that want to spring surprises on the organization, they are nipped in the bud. They are nipped in the bud, and corrective actions are taken to prevent such. Right? Then the next importance of corporate governance is that it's for public acceptance, because the public is yearning for the introduction of corporate governance for most public institutions or public corporations. So it is fulfilling the needs or the desires of the public as regards corporate governance. Okay. Then for public image is another reason for corporate governance. So that itself helps to maintain a good image for the organization. All right. So we look at all of this earlier on. We look at all of that. I was having network issue. That's why. Hope you can hear me now. All right. Okay, thank you. So I was just doing like an overview of what we have done so far before we go to the last aspect. Okay. Now, for the last aspect, now, do you have any question for what we have discussed so far? If there are no questions, let's go to the next aspect that I want to look at, which is the laws and conditions of laws and regulation in the audit of financial statements, ISA 250. That is where we are. We have looked at audit committee. I've explained the functions of the audit committee. We have looked at the objective of audit committee. We have talked about money laundering. We have looked at what the law says, the act says about money laundering. All of this were discussed in details. Now let's go to the last part for tonight, which is the considerations of laws and regulation in an audit of financial statements. Now, one thing we need to note here, let me give some explanation here before we start, or preamble before we start. Now, this aspect I want to go through now was tested sometime around 2020 or 2019 thereabout, where the question was explicitly stated that explain the conditions of laws and regulation in the audit of financial statements according to ISA 250. Now, when you see a question like this in examination, first of all, it relates to audit procedures. Anytime you see a question that relates to audit procedure, it means that you have to go step by step. Once you miss the step, you are not going to arrive at the same opinion or same position as the engagement partner, the auditor in charge of the engagement. So please, for example, anytime you see anything making reference to ISA 250, what it means is that there are audit procedures you need to follow. Okay? Ensure you have understood those procedures before you delve into answering that question. But sometimes you think it's a simple question. You start answering, you come to the point that, oh, this is not as easy as earlier expected. Okay, so when you see a question that relates to the national standard auditing, whatever, is a pointer to the fact that you need to have an understanding of the audit procedure of that auditing standard. All right. So let's look at this together. Now, when you talk about considerations of laws and regulation, what it means is that I'm going to break it down as easily as possible. When we talk about considerations of laws and regulation, what we mean is that there's no audit that you do that you not make reference to identifiable uh, regulations, laws, or legislation. So, as an auditor, you need to have a good understanding of all the laws and regulations that affect your client's businesses. Okay, so that you are carrying out the engagement, you would have observed diligently these audit procedures that we want to discuss now, ISA 250. Number one, what you need to realize when you are auditing financial statement for your client, you have to consider that you must have obtained sufficient appropriate audit evidence, okay, regarding compliance with the provisions of those laws, okay, generally recognized to have a direct effect on the determination of material amount and disclosure of the financial statement. So you must have an understanding. For instance, I want to audit a bank now. You cannot say that you don't know all the laws that you need to comprehend before you can commence the audit of any bank in Nigeria. Okay, that's what we mean. Aside from BUFIA, there are other laws you also need to commit to memory or to have an understanding of before you can start the audit proper, before you can start gathering audit evidence. Number two, you have to ensure that you perform specified audit procedure to have identified instances of non-compliance with other laws and regulations that may have material effect on the financial statement. What this means is that you have to ensure that it's only when you have a proper understanding of the laws and regulations that you're able to know when there are non-conformities. Okay? So you need to know the effect of those non-conformities on the financial statement. Okay? For instance, the audit of banks, you are being asked that, you are being asked that you need to know the prudential guidelines, and you saw on the financial statement of the bank that there are some bad debts that they still carry in their books. Knowing fully well that the prudential guideline is very clear on bad debts. Okay, so you did not follow the laid down procedure of prudential guideline on bad debts. The auditor will take it as a what? And we take it as an audit exception. And we need to ask them that why are you still carrying this in your book? I thought you should have written it off. They know that when they write it off, it's going to have an impact on their bottom line. So most time they will not write it off until when it's being spotted or being directed or being compelled to do so. Okay. Then we go to the next procedure. The next procedure is to respond appropriately to identified or suspected non-compliance with laws and regulations identified during the audit. So what this implies is that there is need to ensure that the non-conformities are responded to immediately, okay, in such a way that it does not affect the entire audit engagement as a whole. Okay, that's what it means by saying that to respond appropriately to identified or suspected non-compliance with laws and regulation identified during the audit. So they must respond to those non-conformities that were being identified. Now, what are the procedures to help identify instances of non-compliance? Number one, you might need to make inquiries of management as to whether or not the entity is complying with relevant laws and regulations. You need to ask your client, I hope you are complying, I hope you comply with all the laws and regulations when you're buying this financial service. It's just a question you need to ask them. And the answer will be either a yes or a no. Okay, you might need to ask them that question. All right. Number two, you might need to inspect any correspondence with the relevant authorities. What does that imply? So you need to look at your client correspondence file. So that file contains all correspondences with all government agencies, be it from LRS to FRS to NDIC and every of those government parastatals. So if there are information that came on board or that came earlier than now, and there's possibility that the organization have not effected some of those recommendations of that committee, of that report, of that correspondence. For instance, if a company has underfiled their taxes for a year, okay, so what that implies is that the auditor, we need to review that correspondence and see that, oh, these are the effects of filing wrongly. So he quickly act or quickly inform the management, okay? Sometimes by doing this, the essence is to be able to put them in the know, let them be aware of what transpires or what happens, okay, upon the detection of some correspondence that they ought to have acted on before now, which they failed to do. All right. So they will need to obtain written representation from management that all known instances of non-compliance or suspected non-compliances have been disclosed to the auditor. So auditor will request for a written representation. So what is a written representation? Now, written representation is one of those documents that is required. It's one of those documents that is required during audit engagement. All right. It's one of those documents that are required. What are those documents required in every audit engagement? The first one, you have the letter of engagement, which specify the terms and conditions. Okay, terms and conditions for a particular engagement. Okay. Now, what you need to realize is that without the letter of engagement, you cannot commence an audit engagement. Okay. So the written representation is a statement that provides to the auditor to confirm certain matters or to support other audit evidence. So what we are saying here is that the written representation is used to remind the management of their assigned responsibilities. Okay? You use it to remind the management of their assigned responsibilities. So another use of the written representation is that it can be used as a form of audit evidence, even though it is weak. Why is it weak? Because there are no much information that contain the written representation. It's just to absolve the auditor of any negligence where it's being reported. Okay. Then you have the third letter, which is the management letter. Now, the management letter is a letter that highlights the weaknesses in the client standard control system, and this usually accompanies the auditor's report. Later, you are presenting the auditor's report. we also go along with the letter of weakness that we presented thereon. Okay. Then we go on to this. Document all identified or suspected instances of non-compliance and the result of discussions with management and other parties. So any instance of non-compliance, you need to document it first of all as an auditor. Then what is the fallout? What is the outcome of discussion with management? You have to document that also. Okay. Then you need to also look at what are the results of the decisions with management and other parties. So at the end of the day, what did the management do? What did you advise the management to do? All of this information must be what? Documented. Then the next one is actions by the auditor in the event of non-compliance or suspected non-compliance by the client company. Sometimes the auditor will need to review the action taken by the client company. Okay, we need to review the action taken by the client company because it will serve as part of it will form part of the audit working paper in future. All right, it will form part of the audit working paper in future. So there is need for actions to be taken by the auditor in the event of non-compliance or suspected non-compliance by a client company. Okay, I hope we are getting it. Then the next procedure is if the auditor identify or suspect material areas of non-compliance by the company, the following procedures are required. So if the auditor sees that there are a lot of non-compliances or non-conformities, then these are the decisions the auditor can take. Number one, obtain an understanding of the nature of the act and circumstances under which it has occurred. Obtain an understanding of the nature of the act and circumstances under which it has occurred. So the auditor will need to have an understanding under what condition did this non-conformity arose. Okay? Under what condition did this non-conformity arose? All right? Then you need to evaluate the possible effect of non-compliance on the financial statement. You need to evaluate the possible effect of non-compliance on the what? On the financial statement. So what we are saying in essence is that for the auditor, anytime you observe non-conformity, two things he needs to do. He needs to obtain an understanding why the circumstances, or the circumstances that led to the occurrence of some of those non-conformances or non-conformities. Then we need to evaluate the effect of non-compliance on the financial statement. The effect of non-compliance on the financial statement. Okay, so those are the areas that we will need to also have a look into. All right, I hope we are on the same page. Any questions so far? Do you have any question? If there are no questions, is there any question, please? Any comment? Any comment? Any observation? So if there is none, right, we might need to extend further to another topic, which is the chapter 4. All right, we might commence chapter 4, even though we might not be able to finish it today. We might need to commence chapter 4, which is talking about professional responsibility and liability. Professional responsibility and liability. Now, what does this entail? Or should we let's look at chapter 3. Let me not look at chapter 4. But what I'm looking at chapter 4 is the fact that we have another facilitator that will take us on chapter 3, right? That's why I'm taking chapter 4 today. So that will be taken by another facilitator. Chapter 3 taken by another facilitator. So let's go to chapter 4. Chapter 4 is looking at professional responsibility and liability. Here we'll be looking at auditors' expectation gap, auditors' liability, and expectation gap. So what do we mean? Now, if you look at this particular topic, right, you will agree with me that auditors are seen as infallible, that they cannot make mistake. They cannot make mistake. Okay, so because they cannot make mistake, there's never a time when they believe that there could be negligence until when instances occur. Okay, until when instances occur that they were able to reason and understand that auditors are also humans as we are. Auditors are also what? Human as we are. So there is nobody that cannot make mistake. All right. So that was what led to what we know as now what auditor's liability. What do we mean by auditor's liability? That sometimes the auditor will act in such a way that will result in what? Negligence of performance, which will result in what? Payment of what? Damages to the affected party. Payment of damages to the affected party or to the injured party. That's what we mean by auditor's liability. All right. Now, what we also need to understand is that when talking about auditor's liability, we need to look at it from two different dimensions. We look at it from the angle of criminal law or criminal liability, and look at it from civil liability. Okay. If you look at it from the law, first of all, let's look at it from the angle of the law. Now, the law, as explained in CAMA 2020, it provides that a company auditor shall, in the performance of the duties, exercise all such care, diligence, and skill as reasonably necessary for each particular circumstance. That is, he must act in line with diligence and skill. He must not be found wanting. Okay? And when a company suffers a loss or damage as a result of the failure of the auditor to discharge the fiduciary duty imposed on him by subsection 1 of the section, the auditor shall be liable to negligence, and the auditor can institute an action for negligence against him in the court. So what we are saying here is that the law makes it clear that auditors should not make mistakes, and when they make mistakes, they can suffer damages, or they can suffer loss, or they can suffer damages, or they can be asked to pay damages as a result of their what? Negligence of duty. Okay. So if the director failed to institute an action against the auditor under subsection 2 of this section, any member may do so after the expiration of what? 30 days. So what we are saying here is that we are looking at two sides to the law, okay, of auditor's liability. We have the criminal liability, we have the civil liability. Now, starting with the civil liability first. Under civil liability, there are two types. You have the law of contract and you have the civil law. Law of contract and civil law, otherwise known as law of tort. Now, under the law of contract, the auditor and the director, they enter into a contract. Okay? They enter into a contract. And because of their entrance into a contract, it confers power on both of them to sue and be sued. Where either party, let's for instance, the auditor failed to perform, the auditor will be said to have what? Committed an act of what? Negligence for non-performance. And when that happens, it's only the directors that can sue the auditor for non-performance in line with law of contract. No other person. Any other person that wants to sue the auditor for negligence will wait for the expiration of 30 days before they can now file their own litigation against the auditor. When they can now find their own litigation against the what? Against the auditor. All right. So that is the order. For law of contract, only the directors can sue the auditor. Any other person that wants to sue the auditor for negligence, you have to wait till the expiration of 30 days. Okay, before any other party can sue the auditor for non-performance or negligence. and that can come in from the angle of criminal or civil. Now, in the case of civil, what civil means is that there is a civil wrong. All right. When you look at the law of tort, it means that what there is a civil wrong. And before you can establish that there is a civil wrong, there are certain things that must be put in place. All right, there are certain things that must be put in place. Yes,
We
can
can
hear
hear you
me?
now, sir.
Okay, the network is failing. That's why. All right, no problem. The class is almost ending. Now, I was talking about the law of tort, okay, which has to do with what? Where there is a civil wrong on the part of the auditor. So when it's a civil wrong, whoever is suing the auditor must be able to prove what the auditor has been negligent in the performance of his duty. So how can you sue an auditor under the civil law? So for you to sue an auditor under the civil law, there is need for you to be able to establish that the auditor has been what? Negligent in the performance of his duty. So how do you determine negligence? You have to be able to prove three things. Number one, that the auditor owes the client a duty of care, and that duty of care has been breached. That's number two. And as a result of the breach of the duty of care, the client has suffered what? Loss. Okay, loss in terms of money. Okay, so once you can prove those three things, the auditor can be prosecuted under what? Under the civil law or law of tort. All right. Now, under the criminal law, that is quite different. Okay. In the criminal law, the auditor they will need to prove the auditor has commit a criminal liability. What are examples of criminal liability? Number one, where he accepts appointment to act as an auditor when he's not qualified to act. When he accepts appointment as an auditor under a statutory provision without being qualified to act, that is, you are not qualified to act, but you decide to take up the appointment. All right, that's a criminal offense. Number two, where the auditor is involved in fraud, such as falsification of accounting documents and records, that can also be seen as a criminal offense. Like what happened in the days in the case of Aero Corporation and Otto Anderson. Number three, where the party or where the auditor is guilty of what? An insider trading or insider dealing. What do we mean by insider trading? What do we mean by insider dealing? This occurs when an individual decides to utilize privileged information at his disposal for his own benefit. Utilize privileged information at his disposal for his own benefit. Like what happened in the case of Aero Corporation and Otto Anderson. When Otto Anderson held or learned that the share price of Aero Corporation will go down, they quickly sold the shares to unsuspecting investors so as not to bear the brunt of those loss in share price. That's what we mean by insider dealing or trading. Another example of that was what happened. Hello, yeah, with you.
Sorry, sir. I just want to ask like this, number three. Is it only made for internal? Because internal auditor must have a knowledge about the company maybe he's working with.
No. This
will
one
also be applicable to external auditor.
No. It's strictly applicable to external auditor.
Okay, thank you, sir.
It's strictly to external auditor. You can meet your system. Okay. It's only applicable to external auditor, right? We are not looking at internal auditor. We look at that one in chapter 13. We look at internal audit and outsourcing. That's why you only see that. All what we are discussing in this chapter 4, professional responsibility and liability, is relates to the external auditor. Thank you for that. All right. Thank you so much. It shows that you are following. The other thing you also need to note here is that another instance of criminal liability will arise when the auditor contributes to the winding up of the company. When the auditor contributes to the winding up of the company, like the case of Enron Corporation and Arthur Andersen, or when the auditor advises the client to indulge in what? Tax evasion. Okay, that would mean by tax law. Or where the auditor encourages his clients to partake in what? Money laundering activities, or where the auditor gives financial advice that led to a loss or losses to the investors. All right, all these three, all these four are other instances of what? Criminal liability that can be brought against the auditor. I hope we are on the same page. All right. So I've looked at civil liability, I've looked at that law of contract, I've just talked about that, I've talked about law of tort. Okay, I've talked about the how you prove negligence on the part of the auditor. I've talked about all of this, right? Then we go to the next one. How can the auditor, okay? How can the auditor help or determine if how can he prove himself that he's not is not responsible for the negligence? Okay, how can he prove himself? Number one, the auditor must prove that he's been negligent. That is, in instances, what we are looking at now is that cases where auditor has constituted a liability to third party. So how will the third party, how will they win the case against the auditor? They must prove that the auditor has been negligent. That's number one. Number two, that financial loss has been suffered. Okay, number three, that there is a direct causal relationship between the financial loss suffered and auditor's negligence. So for instance, if the auditor presents audit report to a bank and and the investor says that as a result of that audit report, they invested and they lost their investment, they can sue the auditor in that regard. Why? Because the auditor should have known that some people will rely on that auditor's report. That is the reason that some people, investors, will rely on that report. So they ought to have acted in a more professional way or manner. All right. Then next, there is or there are no other traceable causes apart from the proven negligence of the auditor. The number five, the auditor had knowledge or ought to have had knowledge that the document prepared or issued by him was to be relied upon in that particular context. That's an example of what I said, that you have the auditor that presents audit report for a bank and investors invested based on the auditor's report and they lost their investment. The auditor will be liable in that regard. All right. Any questions so far? I hope we are all following. So those are the instances of the auditor's liability. So let's look at the auditor's expectation gap. Now, for auditor's expectation gap, what it means here is that there is a perception of the public about the role of the auditor, which necessarily does not tally or correspond, okay, with the statutory rules of the auditor, which does not necessarily correspond with statutory rules of the auditor. That's when you talk about the expectation gap. So, for instance, the public, they have some misconceptions about the role of the auditor. One of it is that the view that the auditor's report is a certificate of correctness. Whenever you see the auditor's report, it shows that the company is doing very well, whether or not. All right. Number two, they also believe that once the auditor issues his audit report, all right, the auditor has examined all aspects of the business. The auditor checks everything. All right. Number three, they also believe that the auditor is responsible for the prevention and detection of fraud. Okay, those are the misconceptions of the public. Those are the misconceptions of the public about the role of the auditor, which contradict the statutory responsibilities of the auditor. All right, so that's what you need to know about the expectation gap, the definition. All right. Okay, now let's look at the three main elements of expectation gap. There are three main elements of expectation gap. The first one is known as the standard gap. The second one is known as the performance gap. The third one is known as the liability gap. Let's look at them one after the other. What is the standard gap? Standard gap occurs as a result of the fact that audit is prescriptive in nature. All right, and because of this, right, the rules and the policies, legislations, they are wide range. So sometimes it might not be possible for the auditor to be able to follow all the rules. And this creates what we know as what? A standard gap. Okay, because it cannot follow everything. It creates what? A standard gap. That is, the auditor is expected to cover every aspect, laws, regulation, all these processes, practice, and everything. But sometimes, because of his human nature, he might not be able to cover everything. And because of that, it creates what? A standard gap. Then you have a performance gap. A performance gap is the gap that explains that the audit work, the quality of audit work has dropped over the years. That is when you see audit do the work now. There are too many times the auditors will be prosecuted for acting negligently, all right, or being involved in criminal activities or liability. Number three, we have the liability gap. And this arises from lack of understanding about the auditor's liability and who the auditor may be liable to. So when the auditor releases audit report on the net, the auditor might not know who is going to prosecute him for negligence or not, because the report will get as far as the farthest region of the earth, okay, and the closest region of the earth, depending on which area they are going to be associating an action against the auditor. They might not be in the know, and that creates a liability gap. All right. So, what are the responses to the expectation gap? Number one, the institution of corporate governance will help to streamline the responsibilities of the auditors and the directors as a whole. Number two, the audit report is addressed to the owners of the company and not to other users of the financial statement. It's usually addressed to the owners of the company. Number three, the use of disclaimer clauses. Okay, the use of disclaimer clauses by organizations or auditors in their report to organizations. So in UK, it's not applicable in Nigeria yet, but in UK, they use what they call disclaimer clauses. So we say that this report is solely for the users or the owners of this business. So anyway that does so at its own risk. That is, if you are not a party, if you are not a shareholder of that business, you should not partake, okay, or rely on that information. If you do, you do so at your own peril. All right. Then those are the responses to the expectation gap. All right. Now we look at rational skepticism and fraud. Now, as an auditor, anytime you are going for an audit, there is need for you to ask that question. The year under review, has there been any instance of fraud? You need to ask that question so that you have a mindset that fraud has been perpetrated in this organization in the year under review. Now, also, there are procedures to follow when you talk about professional skepticism. Skepticism is an act where the auditor has a probing mind, okay, to asking questions about whatever is being presented to him by the management. He needs to ask questions, okay? Now, that will mean by professional skepticism. Now, these are also procedures. Number one, the auditor should perform the audit with a suitable degree of professional skepticism. That he must ensure that he does not believe in totality whatever the management or the directors have presented thereon. Number two, the audit team should discuss the possibility of fraud in the context of the specific characteristics of audit engagement. So what it means here is that they should discuss the possibility of fraud being happened or being perpetrated in a client business for the period under review. Number three, discussion should be held with management on procedures and control put in place to detect and prevent fraud. So when there are no instances of fraud, the auditor should ask the management, what are they put in place? What measures are they put in place to prevent and detect fraud? All right. Then number 4, the risk of possible fraud should be identified, and the possible impact of the financial statement should be evaluated. That is, they need to review that financial statement is prone to misstatement, okay? And the report, the financial statement needs to be reevaluated, okay, against any instance of what? Fraud or possible fraud. And lastly, audit procedures should be designed to obtain evidence that fraud, which may impair the financial statement, has not occurred or has been detected and corrected. Okay, so what this one is saying here is that the audit procedure should be designed to obtain evidence that fraud, which may impair the financial statement, has not occurred. All right, has not occurred or has been detected or corrected in the financial statement. So that is all about chapter 4. So tonight we have been able to review chapter 4 and chapter 2. Do you have any question? Do you have any comment? Do you have any observation? Please, someone should respond before we call the class a day. Yeah, I'm with you.
Sir.
Yes.
Sometimes in practical, this
Yes.
professional skepticism.
Yes.
Auditors also come in contact with professional dilemma.
Yes,
We
ethical dilemma.
Yes, where clients that you are working for, we will
Yes.
have some personal influence
Yes.
that will come in conflict with your profession.
Yes.
So in such a situation, sometimes it's an auditor find it so difficult to make a decision.
Yes. Okay. So what's the question?
Yeah, what will the auditor do in that manner?
Instance.
I know professional you have to go, but yeah, in that instance.
Okay, no problem. I will respond now shortly. Thanks for that question. Now, in reality, like you said, there's what we know as an ethical dilemma. Okay? And when you have ethical dilemma, what the auditor will need to do is to ensure that it's able to resolve the ethical conflict or ethical dilemma in such a professional way that it does not affect the entirety of the engagement. So what should you do in that instance when you have a difficult client to work with? Number 1, as the auditor, you need to be able to ensure, sorry, I'm coming. Sorry, just a minute. You need to be able to ensure that you're able to state the fact, okay? You're able to state the fact the way it ought to be. You're able to state the fact the way it ought to be. What do you mean by stating the fact the way it ought to be? Now, in every ethical conflict resolution, right, you're able to look out for the relevant facts. So what are those things that the clients are doing that you don't like? You need to be able to analyze them, list them, and analyze them. That's the first thing you need to do. Number 2, you need to look at the ethical issues involved. So what are the issues that you think that are not right ethically? You need to be able to pinpoint them. For instance, you might say that the management, they are not cooperative, okay, in terms of providing information. That could be an ethical issue, right? Or they are trying to influence you to change your decision. That could be an ethical issue. So you need to spell it out. Number 2, you need to look at the fundamental principles that relates to the matter in question. You need to review the fundamental principle that relates to the matter in question. So for instance, you need to look at it. Now, this issue that you just were explaining that makes it difficult for the auditor to work, does it have to do with, does it affect objectivity? Does it affect independence? Does it affect conflict of interest? You need to be able to pinpoint those fundamental principles that are related to that question. The next thing to ask yourself is that, are there any established internal procedures to checkmate some of these activities or some of these issues? Are there any internal procedures? Let's say there are policies and procedures that guide against some of these things. For instance, if there are laws if there are regulations or policies that says that management must always provide information at will or all the time to the auditor. If it's stated like that, the auditor can bring it out and show the management this is what the policy says on the organization. You need to give me that information. All right. And sometimes also we'll be able to look at these established internal control procedures. We need to look at the alternative courses of action. So if that has happened, do you have any other alternative or other ways to resolving this ethical dilemma aside from the ones that we just talked about? Do you have any other way that is going to make peace to reign or be able to work harmoniously with the client, that will not be a repeat of such resistance from them in the nearest future? So these are the steps you need to take when there are ethical conflict resolution. Number one, you need to ensure that you state the relevant facts. Number two, you look at the ethical issues involved. Number two, you look at the fundamental principles related to the matter in question. Number four, you look at the established internal procedures. Then lastly, you look at alternative courses of action. So these are the steps you need to take when the auditor is faced with an ethical dilemma. I hope I've been able to answer the question. All right. Hope I've been able to answer the question.
You very much.
All right. Thank you very much. Any other question, please? Any other question, please? Okay. So there are no questions, right? So what we need to know is that we're talking about professional skepticism. What we are saying here is that the auditor should always have a probing mind to asking questions. Okay, so as not to believe in totality whatever is being presented by the client or client management to be used by the auditor. All right. Thank you so much. So in the absence of any other question, we draw curtains on the class today. So today we'll be able to look at two topics. The first one is the regulatory environment. The second one is the operational responsibility, operational liability and responsibility. So that's chapter 4. So I'll look at those two chapters for today. So we are going to, when we meet next, maybe the other person will take on chapter 3, or I will see the one that will take on chapter 3 and other subsequent chapters. So in terms of any other questions, we draw curtains on today's class, right? So in chapter 4 that we have dealt with today, we will be able to look at auditor's liability, be able to define what we mean by auditor's liability. We look at the various angles the auditor can be liable, which are 3 areas or 2 areas. We have the criminal and civil. Civil is very little too. Law of contract and law of tort. We're able to look at that. We're able to look at criminal liability. After that, we proceeded to the auditor's decision gap. We're able to define the auditor's decision gap. We went further to look at what are those misconceptions of the public about the auditor's role. We look at them one after the other. Then we went further to looking at the elements or responses to those decision gap. We look at that. Then we now went further to look into the element of auditor's decision gap, where we have the standard gap, performance gap, and liability gap. Okay. And after we were able to review that, standard gap, we now decided to look at professional skepticism and fraud, right? Now, under professional skepticism and fraud, we're able to look at the relationship between professional skepticism and fraud, because sometimes when you are being a skeptic, right, when you are trying to practice professional skepticism, they see you as someone that is trying to be subjective. All right, so you need to be able to clear both of them, that both one will lead to the other. Okay, if you exercise professional skepticism, one way, if there is fraud, you're going to unravel. And if there is none, you'll still not find anything within the organization. All right. So those are the things you need to know. So you have looked at 2 chapters today. That's the summary of what we have done today. All right. So the last part that we did not talk about here in this chapter 4 is what we call the out of court settlement. Out of court settlement arises is a new addition to the syllabus. Now, what this one means here is that sometimes when the auditor is being prosecuted, it's not all the time you have to go all out to prosecute the auditor. There are times you opt for alternative dispute resolution, which we call the out of court settlement. Alternative dispute resolution, which we call the out of court settlement, rather than go to the court and prosecute the auditor to the later, they'll reach a compromise. That compromise, what we call the out of court settlement. So it has its effects on the organization or on the auditor's liability. One of the benefits is that you are able to save your legal cost and audit and legal fee. That one you should have given to the lawyers and all those cases moving around from A to B would have been saved. That's one of the advantages of out of court settlement. And number two advantage is that when you look at out of court settlement, right, it increases the exposure. Okay, it increases the exposure of the audit firm, okay, to auditor's liability, because it makes it more known that auditors are now being subjected to negligence. All right, so that is an advantage because people are now more aware about auditor's liability. All right, what are the disadvantages of auditor's liability? Number one is that it does not allow for judicial precedents to be created or to be developed. As you don't have any decided case where auditors have been prosecuted in Nigeria. Because most times, not that we don't have it in Nigeria, they opted for settlement out of court. Okay? That's why we don't have any judicial precedents. Number two disadvantage of this is that more clients will show interest in prosecuting the auditor because they know that somehow, somewhat, there's going to be some reward that they're going to benefit at the end of the day. Number three, the professional indemnity insurance premium will increase, okay, because the auditor will pay more. And when the auditors pay more, the insurance company will increase their premium to the audit firm, okay, as a way of pushing in the effect of the auditor's negligence. All right. So that is the area that I said wasn't part of this one. I'm sending your material later today or early tomorrow. I'm going to include that out of court settlement because we have looked at it, okay, so that you have an unrounded information to work with for this examination. So if there's no question, can we call it a day now so that I can say authoritatively that we have looked at chapter 2 and chapter 4 in one night. So thank you so much for your cooperation. Thank you for your time. Thank you for your patience despite these challenges as by the interconnectivity of the internet. Thank you so much. So we see next again Saturday night, God's willing. Have a good night rest. Thank you so much. So the class has come to an end now. So thank you so much. Have a good night rest.
Thank you, sir.
Good night.